Most people think crossing 2.5 million in retirement savings is the moment all your financial worries disappear. But here's the truth I wish more people understood. That level of wealth doesn't eliminate problems. It simply changes them. It turns small issues into big ones. It attracts attention you never really asked for. And it requires a completely different strategy to protect what you've built. After nearly 30 years of helping high net worth families retire, I've seen the same four traps catch people off guard again and again. And that's exactly what we're going to talk about today. What actual changes occur once you cross the $2.5 million mark? Hi, my name is Jeremy Finger. I've been helping people successfully retire for nearly 30 years. All right, let's dive in. Here's something I hear all the time from clients at this level. Jeremy, the normal retirement advice just doesn't seem to apply to me anymore. And for the most part, they're right. The moment you cross the $2.5 million, you're no longer operating in what the average American financial world experiences. According to the Federal Reserve data, only 9% of households have this much in retirement savings. That means 91% of financial advice that you see online or hear from your friends isn't designed for your situation. It's like going from driving in a quiet neighborhood to suddenly merging into a 6-lane highway. Different rules, different risk, and different consequences. And if you keep using the same strategies that got you there, you can unintentionally sabotage the next stage of your financial life. Let's start with the first major trap. Trap number one is the exclusive opportunity mirage. Once your retirement savings cross into this threshold, something interesting happens. The investment industry certainly treats you like you're a walking opportunity. You start seeing these exclusive invitations for investment dinners, private deal pitches, real estate and private debt funds, complex alternative investments, and products that are labeled institutional. And the famous line, this is only available to accredited investors. And yeah, it can sound flattering, and it feels like you've unlocked some secret level of a financial gain. Most of these investments are designed to make other people wealthy, not you. I review these details constantly from clients, and when you peel back all the marketing, what you end up finding is sky-high fees, vague or incomplete disclosures, long lockup periods of your money, unrealistic investment performance, and, for the most part, a lot of compensation conflicts. Your $2.5 million isn't a golden ticket to some magical realm of great investments. It's a target for people to pitch you because you're now become way more profitable. Okay? One thing I do want to address is the accredited investor label. What an accredited investor is, in simple terms, is that you meet specific income or net worth thresholds designed or set by the SEC. 1 million in net worth, not including your home, or $200,000 to $300,000 of income over the past 2 years. Being an accredited investor doesn't mean the investments are safer or better. It simply means companies are legally allowed to pitch you riskier deals with fewer disclosures because the SEC assumes, number one, you can afford the loss, and number two, you are going to take on the due diligence needed to decide if it's right for you. High net worth clients get pitched some crazy things. I've seen offers for next generation infrared binoculars, medical devices that haven't cleared FDA approval, a new concession product to be sold in football stadiums despite having 0 stadium contracts. A lot of enthusiasm, but little results. And the most common pitch I see is real estate and development deals. Ground up construction, hotel conversions, private equity REITs, the whole spectrum. And they almost always come with lockup periods, unpredictable cash flow, multiple middlemen getting paid before you, and the inevitable K1s. K1s alone are their own headache. A lot of times they arrive late, they trigger amended tax returns, and they complicate tax planning. And often they give you passive losses, but you got to jump through special hoops to even claim that against your taxes. But when you dig in, you quickly realize it's not exclusive because it's special. It's often exclusive because they can't get the funding anywhere else. And that kind of flexibility often leaves room for a lot less than honorable management of your money. But here's something you can do. Use a disciplined, evidence-based strategy when you're thinking about other types of investments. Demand transparency. Apply strict evaluation criteria to any alternative investment. And remember that simple beats shiny most of the time. Keep in mind, the same discipline that helped you build your wealth is the same thing that can protect you going forward. Now let's talk about trap number 2, the government's silent surcharge system. If an investment industry tries to sell you things, the government simply charges you more for making more money. Shocker, right? And nothing illustrates that more than IRMAA, the income-related monthly adjusted amount. It's Medicare's polite way of saying, congratulations, you're successful, pay us more money. Here's how it works. The standard Medicare Part B premium is about $185 a month. High-income retirees up to $630 a month. Part D adds another $13 to $86 per month. A high-income couple can pay over $12,000 per year in IRMAA surcharges alone. And what triggers this is large IRA withdrawals, big capital gains, selling a rental property perhaps, one unusually good year in income, or poorly timed Roth conversions. And my favorite that a lot of times people don't plan for is RMDs you waited too long to prepare for. And here's the twist. IRMAA uses a 2-year look back, so the decisions you make today show up on your Medicare premium 2 years from now. But here's the fix. What you can do is do proactive Roth conversion planning, smooth out your income year by year, coordinate your Social Security timing, manage your RMD tax bombs, and keep your taxable income below certain Medicare thresholds. If all of this sounds a little confusing for you, don't worry. We put together a short video in the link in the description, and it shares with you how we walk our clients through this process. When you get to around the $2.5 million mark, tax planning stops becoming optional and it really becomes essential. And just when you're thinking you're getting your tax plan under control, another problem shows up, one that can quietly damage even the strongest portfolios. And that is called sequence of return risk, which is trap number 3. Sequence of return risk hits a lot harder at this level. Most people think investment risk is the same for everyone, but it's really not. The bigger your portfolio, the more dangerous bad timing becomes. Let me share with you the simple math. A 20% drop on a $500,000 portfolio is a $100,000 loss. I know that sucks. A 20% drop on $2.5 million portfolio is a $500,000 loan. The same percentage, but completely different emotional and financial impact. And here's the scary part. Most retirees enter retirement with a portfolio that's set up for accumulation, not preservation. They're aggressively invested at the exact moment they need more stability. Now, when you add withdrawals to that, you get a nasty combination. If the market falls and you still need income, those early withdrawals amplify the losses. And it takes longer time for your portfolio to recover. And fear can cause you to make some very bad decisions. It is in early retirement that the sequence of return risk destroys more wealth than almost any other time. Here's a chart that shows the impact of sequence of return risk. Both sides are over a 25-year period. Both are taking the exact same withdrawal rate, $50,000 a year, and both have the exact same average return. But on Portfolio B, the negative years are in the early years of retirement, and you see it runs out of money. The reason is you end up taking a larger and larger percentage of the account value, and that can destroy your retirement portfolio. But don't fear, there is a fix. What you can do is adjust your allocation of your investments before retirement. Start building in a 1, 2, or 3 year withdrawal buffer that you can use in case of emergencies or market downturns. You can also reduce volatility without killing your growth by allocating investments accordingly. And you can align your portfolio with your actual spending phases in retirement. It's not about being conservative, it's about being smart with timing, your investment allocation, and coordinating your Social Security benefits. And even if you avoided the first 3 traps, this next one is a big one and it's most often ignored. And that's trap number 4. At $2.5 million, the biggest risk isn't running out of money. It's leaving money to people who aren't prepared to handle it. The statistics are brutal. 70% of wealth is gone by the second generation, 88% by the third, and 97% of wealth is gone by the 4th generation. And it's rarely because of bad decisions, it's because their heirs weren't taught what you know. How money is created, what it's meant to support, why money matters, and how to protect wealth for their own future. Without guidance, even the most well-meaning heirs can make decisions that can permanently damage the wealth you spent a lifetime building. Your money lasts a lot longer when your values get passed down with it. So here's a potential solution for you. Have legacy alignment. And what that means is have early, open conversations with your heirs. Educate your family about the inheritance so they can be more prepared when they eventually get it. Establish charitable gifting strategies that reinforce your values. Establish intentional estate planning that include special trust provisions if you have spendthrift heirs that protect them from themselves. Establish trust structure that provide income for the surviving spouse while still protecting children from a previous marriage. This is a big deal for second and third marriages. Have clear beneficiary protections for blended families so your assets go exactly where you intend. And transparent communication with your heirs, your spouse, and your advisors. You all want to be working together and being very clear with what the overall objective really is. Because wealth without clarity disappears quickly. Part of your responsibility is preparing for the next generation, and that starts with early conversations and a coordinated plan with your estate attorney long before it's too late. Look, you didn't build this wealth by following average advice, and you shouldn't manage it that way either. If you want help applying this high net worth navigation framework to your retirement plan, click the link in the description and we'll show you how our Riverbend Bridge method can help protect your wealth, reduce taxes, and manage risk while designing the lifestyle and legacy that you want. Thanks for watching, and I'll see you in the next video.